What's an investor to do in this environment where we do have inflation that seems to be broad, maybe entrenched? We have a Fed that's on the move. What does an investor do? What's overpriced? What's underpriced?
Well, the good news is in a period where there isn't very much of it, is that both the 40 and the 60 side of the 60-40 paradigm, I think, are now really attractively valued. I mean, you can get a 10-year yield at a 10-year note at 4.2, a 2-year note at 4.5. You can buy the S&P 500 at around 15, 16 times forward earnings. Now, that PE is only as good as the forward earnings, so we will find out whether the earnings hold. So far, they have. So valuations have had a tremendous reset from the overvaluation days, following the COVID lockdown, when the Fed basically repressed interest rates down to much lower levels than they really deserve to be, and that raised asset price inflation in the stock market, because again, interest rates are an important factor in valuation. And so it's been a very painful 9 months during which neither the 40 nor the 60 has worked. That's a very unusual environment to be in. But I think the good news is that if the Fed does overshoot, I think the 40 will really present a lot of value at 4% plus yields, and maybe the 40 will start becoming negatively correlated again to the 60. And if a recession is averted, then the 60, I think, will do well, because earnings then will likely hold up and valuations are now much more reasonable. So for me, the glass half full view here is that at least one of those two engines is going to start working. I can't tell you which one it is, unfortunately, but I do think it's not going to be any longer this monolithic market where basically nothing works.
Sonal, when will the bond market be the engine that starts working? Are bonds getting cheap enough now that it's time to go back in?
They're beginning to look interesting. Let's put it this way, because if I look at investment grade bonds, I look at short paper. We just discussed, Jurrien just discussed that we were talking about 4.4, 4.5. I think we're getting to interesting levels. We're seeing something finally that we haven't seen for, again, close to 17 years, fixed income delivering income. What a concept. I think income becomes more and more important as we look forward. I do think that 10-year yields are likely to still go up. But having said that, it does start becoming attractive. So over the coming weeks and months, I think the first step would be areas like investment grade, because you're getting paid healthily to hold good credit. And our baseline is not to have a steep recession. We'll have a recession, but I think we might be able to avoid a steep one, which means that fundamentals can still look good. And furthermore, if I look in areas like high yield and emerging markets, we are now getting paid between 8 and 10% in these areas, which means that finally liquid fixed income starts becoming a very decent alternative to alternatives, which up till now have really been the only area in the last multiple years that could deliver those style of return. So I actually am also glass half full at this point for the first time in quite a while.
Jurrien, just coming back to you on discounted cash flow way of looking at stock valuations, as I understand it, in fact, you've taught me, in fact, the Fed has been buying bonds, but they've also been buying tips. Is that skewing that as a measurement?
Yeah, it's interesting you mentioned that, because I'm trying to figure that out actually in my latest research, because the Fed owns 33% of the Bloomberg Tips Index, so that may not be all tips. So the overall number will be less than that, and so it makes you wonder whether there's any price signal left. But when I compare, for instance, the tips break even to the inflation swap market, which is a direct swap, I don't really see a tremendous amount of price distortion from the Fed owning so many tips. And of course, the Fed owns a bunch of nominals as well, so maybe one cancels out the other. So I think the jury is still out, but clearly the tips market is saying a different message than the headline inflation numbers are, because the tips break-evens are around 2.5 across the curve, and that's totally different from an 8% CPI.